What's up you guys, Charles here and welcome back to the channel. Now, I know I haven't done a lot of investing videos recently, so here's one for you, and today I'm going to go over an investment portfolio called the 3-Fund Portfolio. It's an amazing portfolio because it allows you to spend almost no time managing it. It uses 3 index funds, which you know I'm a huge advocate for. Now, if you're new, why am I a huge index fund advocate? I do have a video on it, but to sum it up, essentially they have very small fees, they allow huge diversification, and Warren Buffett would put all his money on it, so I'm going to put all my money on it too. Now, 2 big rules when you're investing are diversification and asset allocation. Now, a great book that explains this and just explains personal finance and investing in general is Money Master the Game by Tony Robbins. I don't have the book here, but it's a great book and it explains almost everything on personal finance in the space of one book, and it's just amazing. I really recommend you go read it. However, I think it's 600 pages, but it's a pretty easy read for an investment book, written by Tony Robbins, and all the money goes to, I think, Feeding America, or the charity he runs that helps feed people in America, so all the profits go to that. But the shorter version of the book is called Unshakeable. I'm not sure how long that is, but I think it's just more to the point version of that book, so you might also want to go read that. I really do recommend you go buy that. I think it's only like 6 or 7 quid, and it will save you probably hundreds of thousands. So yeah, go read that first. Our 3-fund portfolio allows you quite a big diversification, as well as decent asset allocation. It's made up of bonds and stocks. Now, it's true that it doesn't have commodities such as gold in it, which can be seen as a problem, but since this channel is mainly for people under 30, with a big stock exposure in this portfolio, it means that you're taking more of a risk, and there are portfolios where you take less of a risk and have decent return. It's called the all-weather portfolio, and it's made by Ray Dalio, the guy who literally, who is the hedge fund manager, or was actually, I don't know if he's retired now. I think he's still there, but the hedge fund manager of Bridgewater Associates, which is the biggest hedge fund in the world, and at some point managed 160 billion, it might even be more now. But he essentially had a portfolio for the most important clients, which had to have a net worth over, I can't quite remember their net worth, but it had to be a huge amount, and the minimum investment had to be something like $5 million. To be able to invest in this portfolio. But essentially the portfolio is made for all economic seasons. So there are 4 main economic seasons. So there's unexpected inflation, unexpected deflation, unexpected economic growth, and unexpected economic decline. Now, in those seasons, different types of assets do well or badly. And so he analyzed over the past 75 years or whatever, what does well and what does badly in different economic seasons, and has made a portfolio dependent, based on risk and other things, those things that would go over my head or anyone's head, but he's a specialist in these things. And so he shared it actually in the book I was talking about, of Money Master the Game by Tony Robbins, where he shares this portfolio, and in the past it's performed really well. I think the maximum loss it had is 4%, and that was during the 2008 financial deleveraging, just the crash of 2008 essentially. And whilst the stock market was down something insane, like 50%, I think, it lost a huge amount during that time. So you want that to limit the amount of loss you can get, but it's also limited on the amount of return it can get, which is kind of a bad thing if you're young, because when you're young you can take more risk for a higher return because you have less to lose, but as you get closer to your retirement you want to have a more bond heavy portfolio so that you're less at risk. However, this 3-fund portfolio offers a pretty big risk exposure, but is well diversified across bonds and stocks, and you can arrange these 3 funds depending on how much risk you want to take. Now, yes, I know I was rambling on about other stuff. I'm going to tell you right now what the fund's about. So you have a certain amount in bonds, certain amount in total market, so international market stocks, and certain amount in the US stock market. So as I said before, you can take your percentages of this portfolio and change them, increase them in bonds if you want to take less risk. But essentially, this is what it is. It's 80% in S&P 500 index funds. So the Vanguard 500 is one of the lowest cost ones made by Vanguard, and you can use them on their platform. You should invest in these inside an investment savings account if you're in the UK. If you're in the US, it's a Roth IRA or 401k. And in the UK, it's either an ISA or a pension. Now, there's also 10% in bonds and 10% in total international market cap. Now, the specific index funds you need to pick are the Vanguard Total Stock Market Index Fund, or the VTSAX, the Vanguard Total International Stock Index Fund, or the VTIAX, and the last one for bonds is the Vanguard Total Bond Market Fund, or the VBTLX. The great thing with the 3-fund portfolio is that you only need to change it or even have a look at it once or twice a year. Now, you should take a look at it once or twice a year to rebalance it, to make sure that you're still 90% stock, 10% bonds. And over time, you should increase bonds asset allocation more and more. But as I said, since the channel is mostly under 30-year-olds, you should have 10% bonds, 90% stocks for maximum growth. Now, you should only be investing for over 5 years, and this is retirement stuff. So essentially, it should be 30 to 40 years that you should be looking at for investing. Any less than that, and you probably shouldn't even be investing, to be honest, because if you look at the S&P 500, for example, over time it's had an average of an 8% return, but that's over time. Some years it might be down, some years it might be up. But over the long term, you can almost be assured that America, for example, will do well because it's a capitalist country which capitalizes on opportunities, and with more opportunities, you have more companies doing better, such as Amazon, Apple, and what do you name it. And is one of the reasons why it's a superpower. Now, this is a 3-fund portfolio, but you can change it if you want to. But this is recommended by Jack Bogle, the founder of Vanguard, and a very experienced guy within the stock market. But if you think you're better than him, which honestly, don't even try. If you look at the stats, something like 95% of all stock pickers fail to beat the market, and these stock pickers have access to every single piece of information that you don't have to. They have access to it through Bloomberg and other softwares, and they can value the stock market and see if the price of a stock or a fund or whatever is perfect or not. And if you know more, then you'll probably be done for inside trading, because if you know that the company's about to go bust before everyone else does, you can be arrested for that. Point is you can change it. You can, for example, instead of taking the S&P 500, take the FTSE 100, for example, if you think that's going to have a greater growth. Which it might, to be fair, because over the last 10 years, the FTSE has been pretty flat, although it's had ups and downs, whilst the S&P 500 has been growing fairly exponentially. And some experts do say that it's overvalued, the S&P 500, and other stock markets such as the Nikkei 225, for example, the Japanese one, might be better. But the reason they have a total international market is this covers all stock markets over the world, so you're still getting growth from other places, not just America. But just remember that you're diversified through index funds, you're diversified through bonds and stocks. You have an asset allocations of bonds and stocks, so you're covered through that, although you might want to include gold in it, but that might be something else you want to look at outside of this portfolio, because gold does well in uncertain times. Although at the moment I wouldn't invest in gold, but you might want to if you think that it's a good investment, but that's up to you to decide. You need to remember to balance once or twice a year, rebalance it, make sure the percentages are still the same, because one might grow bigger than the other, but you need to make sure you're still at the same percentage, because otherwise you might be taking unnecessary risk or taking too little risk, depending on how the stocks and bonds do. That's literally it. You only need to look at it 2 times a year, follow those 3 index funds that you're using, and you're basically done, and you can just invest it for retirement. Sounds too easy, but it's basically that. Now, another thing you really need to consider is to smash that like button. It really helps me and the channel reach more people thanks to the YouTube algorithm. Now, if you're new to the channel, I'm basically trying to help under 30-year-olds understand more about money, how to manage their money, how to leverage their money in the best way, and how to make more money through saving, investing, and tracking expenses. Now, if you've gained any value from this video or have any questions, do smash the like button if you haven't already, and drop a comment if you've got any questions or any comments, of course, and make sure to subscribe if you found this interesting and want to hear more about this. See you next time.